What's up, everyone? We got a really good one today, and so strap in. And of course, all the OG house cats drop a meow in that chat. You're watching More Money. Let's get it. What's up, guys? So Alibaba has been on a downtrend. You can see that it started the year somewhere around the $75 to $80 mark, dropped, and then just sort of like piddle paddled around the 70 to 75 range, increased a little bit, but now it seems like it's going back in the direction of that $65 per share level. We'll see where it goes. So year to date, the share price is probably a little bit different than less than 5% or closer to a 5% decline. But we'll see where this goes in terms of what the market is expecting. This is from Seeking Alpha, and the company's trading at just around 9 times earnings. And so when it comes to the Alibaba share price being on a decline, you guys know that for years now I've been sort of wheeling this thing. And, probably one of the few people that have actually been making money on Alibaba. Actually, I know a lot of people on the Patreon, just people in general that follow this channel, tend to be a little bit more on the intelligence side in terms of value investors. And I know some of you guys have been wheeling this thing and making money. And so I wanted to take a look at the options and see what the yields look like. Now, the first thing that you'll notice is how, if I'm going to price out the covered call, ultimately you're owning the shares as well as selling the call option at the current share price. And so you are going to get the dividends for the shares, but make sure that you don't price it wrong. When I first priced it, I realized that I put in a dividend rate of $2 per share without even thinking. And it was only a little bit after where I realized, oh, wait a minute, the company's not paying $2 a share in dividends. They're paying $1 a share. And so why is there a discrepancy here? And before even that, I just want to point out that some of you guys have been messaging me and asking when the Alibaba model will be updated for the annual results. In fact, guys, the model has been updated since May 19th. So here's the thing. Just because I'm not making videos and publishing them on YouTube doesn't mean I'm not doing work in the background. And so, this tracker here that you guys do get access to at the Patreon, and I'll just show you guys, right here at the lower level of the Patreon at $5 a month, you guys do get access to the tracker. And of course, if you want to join us on a live monthly call and get access to special courses and the comps, you can join us on the higher tier. But just FYI, let's go back here. This tracker is not necessarily a product that I sell. What it really reflects is a tracker that I use for myself. And so this is where just giving access to this at such a low dollar amount makes a lot of sense, because I would be updating it and tracking it for my own purposes anyways. And so this is why I've never actually increased the price. This is why, you see YouTubers handing out subscriptions to this kind of stuff at like $20 a month, and I just give it $5 a month, because it's less about making money. I mean, of course, it's nice to see a check at the end of the month, but it's more about getting you involved, and you see how these models are built. Of course, you can click in to the Alibaba model right here. You can get access to the Alibaba model and see exactly how I get to the the $177 per share price. Really, what's going on there, $173 share price. Those numbers are so close, it confused me. But really, what's going on there is I'm modeling this in a different way than I think the market is. The market really is modeling it at 8 or 9 times expected earnings, and not giving them any credit for any of the excess capital on the balance sheet. So if you were to take the excess capital off of this, you'd probably see a valuation of maybe, I don't know, 110, 120. You guys tell me in the comments below what you guys have it valued at when you take the excess capital out. But I haven't taken the excess capital out really because I believe that the company has made progress in returning capital. And so, I just wanted to point out the fact that the company has been remodeled since May 19. And once again, just because I'm not making videos doesn't mean that the work is not being done in the back end. And of course, our monthly calls are also going on. Now, the other thing is that I wanted to show a couple of other names. Target got updated on May 22nd. And American Eagle got updated on June 13th. Target was an interesting one because it was coming, it was definitely trading under 100% of its intrinsic value. And I think after I made this snip. I think the market actually realized that Target ran, or Target was cheap, and it ran. You guys correct me in the comments below. I don't have a screen open in front of me to see what the current share price is at the moment. So once again, just looking at Yahoo Finance, be careful, because it's not just Seeking Alpha that's showing a $2 per share dividend. Yahoo Finance also is. And so be careful. Make sure that you use $1 a share for the divvy when you model this thing out, not $2 per share. And so why would the aggregators of the data even show $2 per share? You guys might recall that when they announced their dividend, they actually announced their regular dividend of $1 per ADS, and then they announced a bonus dividend as well. But it was only 66 cents per ADS, so I'm not sure where the $2 came from. Once again, you guys can correct me in the comments below, but or add more information as to how we get to the $2, because I'm getting to 1.66, and so I don't understand it. But at the end of the day, the run rate for me is correctly stated at $1 per share. And so what do the options look like? You know, when I'm looking at sort of like the at the money options, it doesn't really matter if it's a call or a put. I just like looking at the calls. And so you can see at $72.50 for the January 16, 2026. I know some of you guys don't like wheeling really long-term options. I do, because it just gives me a lot of downside protection, and I'll show you that in a second relative to the intrinsic value. But you can see that you're probably going to pull anywhere from $15.50 to $18.50. It looks like the last trade was $16.50, and then the 75s is $14.55 to $15.65. It looks like the last trade was around $15. I think that's fair. And so that's what the prices look like. And we'll price both of these. And the reason why I want to price both of these is because the current share price is in between these two numbers. And so it's always fun to see. They generally end up in the same place anyways. So first things first, this options calculator, I originally was going to make this a premium feature, but I realized, you know what, man, like I don't really care that much about making money on this channel. And so I actually gave this guy to you away for free. And so in every one of my videos, including this video, you will see a link to the free options calculator, which you can use and adjust it as you wish. You can download it and adjust it as you wish, because some people like to look at things differently. I think this is a very this is one of those things that's not really covered, you know, options investing for value investors. And so you get a good perception of sort of how I do it. And of course, the way you do it could be completely different. And so, you know, you can see that I've put in the appropriate price, the January 16, 2026. $72.50 is the strike price. The premium is $17 per share. The dividend correctly at $1 per share. And so, of course, you work this through, and it's a 19.84% annualized yield if you are assigned on the covered call, which means the current share price is $73.35. If by January 16, 2026, the share price remains above $72.50, you will get assigned on this. And so your return will just be the premiums that you received plus the dividends less the capital loss, because you bought the shares at $73.35 and you had to give them up at $72.50, so there's a bit of a loss there. But your annualized return over the 579 days would be approximately 20%. So I like that. But then the next thing that I want to look at is, what does the equity yield look like if I'm not assigned? Because it's a binary with options, right? Only two things can happen. You either get assigned or you don't get assigned. So, you know, situation A looks really good. What does situation B look like? Well, you can see that the net purchase price of the company, which is the share price less the premiums and dividends. And personally, as a personal preference, I deduct dividends to look at the cost basis for the duration of options, but you don't have to. Some people actually don't like to deduct the dividends. So your cost basis might just be a little bit higher. I think it leads to the same conclusion ultimately in this particular situation, but in other situations, it might be it might be the difference between you buying or not buying, or selling the option and not selling the option. So just keep that in mind. I don't claim to have a monopoly on the best approach. You guys let me know what you decide to do. I left the valuation at the 173. So in terms of a cost basis as a percentage of the valuation that takes into account the excess capital, we're looking at around 30%. So if any time this is under 50%, then I think it's a very large margin of safety relative to its intrinsic value. However, the other thing that I like to look at is, what does the earnings yield look like? Well, $8.95, which is their fiscal year 2026 free cash flow per share net of the cash that would be required to repurchase what I believe and what I forecasted their stock options issuance to be will be $8.95 per share. So their free cash flow per share in FY26 will actually be higher than this $8.95, but I've reduced it for the dilution. So just keep that in mind when you look at my free cash flow per share run rate here. And so $8.95 divided by 56.35 gives you 16%. So I love when this is above 15%. I love when this is above 15%, and I love when this is under 50%. So this almost seems like the perfect option opportunity for me. And so, I'm not going to tell you guys what to do, and I'll never recommend to buy and sell a stock. That's not what the point of this channel is. The point of this channel is to teach you how to fish, not give you fish. But this is a relationship that makes a lot of sense to me, especially in a portfolio where my Alibaba positions have come off profitably. And so, looking at the $75 per share strike price, you see you get a slightly lower premium, but of course, you're going to get a capital gain if you get assigned on it, because the stock price has to go higher than 75 for you to get assigned. So really what that means is it's less likely to happen, but I still think it's the likelihood of it happening is relatively strong. And so you have effectively the same 20% annualized yield. Cost bases are approximately the same. The equity yield is approximately the same. So, as expected, there is no material variance between these two, and there really shouldn't be. And so once again, I'll leave it to you guys to decide if this potential opportunity is something that you're considering. Do you still own Alibaba? Is it something that you're interested in? And once again, I'd love to say that you can get access to all of my research at the lower tier. This is the $5 a month tier in our Patreon. And if you want to join us for an epic live presentation, you can join us at this higher tier. And so I'll leave it there for you guys, and I'll see you later.